Welcome to Alpha Insights. I'm Ryan. Today we're digging into why the market just effectively stamped its approval on optical networking as core infrastructure. With me is Jessica, our resident voice of reason on tech and markets. Jessica, great to have you.
Thanks for having me, Ryan. Excited to walk through this. It's one of those stories that went from theory to capital flow practically overnight.
Quick note for listeners. If questions pop up while we talk, you can ask us at stockalpha.ai. All right, Jessica, start simple. What happened that made this feel like a turning point?
Sure. Late last week, the S&P 500 committee updated the index and added a few companies. Two of them, Lumentum and Coherent, are deep in photonics and optical components. Their simultaneous addition is more than coincidence, it's institutional validation.
So when the index adds a company, it's not just a badge. There's real money behind that, right?
Exactly. Index inclusion triggers forced buying from every passive fund and ETF that tracks the index. We're talking about trillions of dollars of assets under management that have to rebalance. That creates immediate demand, and more importantly, it signals where institutional capital has already been flowing.
Okay. The headline term people are using is the Optical Supercycle. Walk me through that without the buzzwords.
Think of modern AI data centers. We've got massive numbers of GPUs and custom chips doing the compute. The limiting factor now is how fast you can move data between those chips. Traditional copper connections are hitting physical limits, too hot, too power hungry, and not fast enough. Optical interconnects, using light, solve those problems at scale. So as AI compute scales, demand for optical gear ramps sharply. That's the supercycle.
I mean, when you look at the data, that makes intuitive sense.
Right. Companies like Coherent make transceivers and lasers, the physical plumbing. Lumentum focuses on switches and co-packaged optics. Add in firms that build the silicon routers and switches, and you have the whole infrastructure stack being rebuilt for optical.
So that brings us to the smaller names. Poet Technologies keeps getting mentioned in the chatter. What's their angle?
Poet is a Toronto-based company building an optical interposer. Basically, a way to integrate photonics and electronics on a single wafer-level platform. The pitch is lower cost, fewer assembly headaches, and better performance versus legacy methods.
They've had some actual non-trivial wins, right?
Yes, they booked a production order worth about $5 million and expect shipments of 800 gigabit capable transmit and receive engines in the back half of this year. They also have a partnership with a major contract manufacturer, Foxconn Interconnect Technology, and got strong industry recognition recently for one of their modules.
Interesting. And their balance sheet?
They completed a registered direct offering that raised roughly $150 million, and they don't carry significant debt. So they have a runway to scale production, fund R&D, and pursue strategic steps, which matters for a company at this stage.
But there's a valuation gap between Poet and companies like Coherent and Lumentum. How should investors think about that?
Poet trades at around $6 a share, with a market cap in the neighborhood of $700 to $750 million. Coherent and Lumentum are multi-billion-dollar companies with proven revenue streams. Poet is earlier stage. Revenues are in the hundreds of thousands of dollars per quarter right now. So the upside exists, but so does material execution risk. It's not a small difference. It's a different place on the maturity curve.
Right. Higher reward, higher risk. What are the concrete milestones we should watch that would move the needle?
A few things. First, industry visibility this month. They're exhibiting at a major optics conference in mid-March, where they'll get attention and an award presentation. Second, the index rebalance effect later this month should create a spike in attention for the broader optical sector. Then, on the product side, Poet's shipments in the back half of the year from that production order are a real execution proof point. Also watch prototypes and co-development milestones with partners for the first half of the year. Those validate roadmap credibility.
So if I'm an investor who likes thematic tech bets, How would you frame an approach?
Diversify by maturity. If you want exposure to the optical transition with lower execution risk, consider established suppliers and infrastructure names that already have scale. If you're willing to accept higher volatility for potentially higher upside, a smaller company like POET could be a satellite position, but size it accordingly. Watch cash burn, customer conversions, and manufacturing ramp closely.
Yeah, that's a good point.
And the real question here is whether the optical build-out continues at the current pace. Index moves tell us institutional capital is already prioritizing this layer. Execution will decide which smaller companies join the march.
Final quick takeaways for listeners?
Okay, 3 quick ones. 1. The S&P changes signal institutional validation that optical interconnects are infrastructure, not a niche fad. 2. POET is an interesting early-stage play with real technical partnerships and cash on the balance sheet, but it's pre-scale and carries execution risk. 3. Watch near-term industry events this month and the product shipment schedule later this year as the clearest catalysts.
Solid. Jessica, thanks. That was clear and actionable.
Thanks, Ryan. Always good to break these down.
Listeners, if anything we discussed today sparked a question, ask us directly at stockalpha.ai. We answer listener questions live. And for more market insights and episode notes, head to stockalpha.ai. That's it for Alpha Insights.